Hi, my name is Christian Waldegrave, Head of Research at Teekay Tankers, and this is our tanker market update for August 2018. Well, we're now about halfway through the third quarter of the year, and the third quarter is usually the weakest part of the year for tanker spot rates, especially during August and September. This is normally the time of year where we've passed peak summer demand, and the refineries are starting to gear up for seasonal maintenance. So we would normally expect rates to be quite weak at this time of the year. However, we've been quite encouraged by the rates that we've seen so far in the third quarter, especially compared to the rates that we saw in Q1 and Q2. And we've seen a bit of volatility creep back into tanker rates that we haven't seen for several months. VLCC rates, for example, hit a 9-month high of around $15,000 per day in the last couple of weeks. Suezmaxes have been trading pretty steady around the $11,000 to $12,000 per day mark. But in the Aframax market, we've seen some real volatility, especially in the Atlantic. In fact, rates in the Mediterranean and Black Sea spiked as high as $20,000 to $25,000 per day in the last week or two. And that's really encouraging to see this kind of volatility at this time of year. And it's the kind of volatility that we just didn't see at all during the first half of the year. So this is a really encouraging development. By no means are rates strong. They're still well below the long-term average. But the fact that we're seeing some volatility in Q3 is a sign that perhaps the market is starting to tighten. And this volatility started to come in June, July, which kind of coincided with an increase in Saudi and Russian export volumes after the OPEC meeting on June 22nd, when OPEC pledged to increase supply in order to keep the market well balanced. And we did see an increase in cargoes in June and July. It's kind of leveled off now during August, but it gave a little bit of a boost to tanker demand. And on the supply side, we've seen that scrapping has remained fairly strong through the year. In fact, the tanker fleet has only grown by 0.3% since the start of the year. So you've essentially had a very flat tanker fleet in terms of supply, and now you're starting to get some cargoes back, and that's driving a little bit of volatility. So this is a positive development, and we think it could be perhaps a sign that we might have passed the bottom of the tanker market cycle and into a phase of tightening now. Looking ahead, we would expect the next couple of months to be still relatively weak in terms of freight rates. As I said, Q3 is normally the weakest part of the year, and we do expect that refineries will go into maintenance, probably peaking in September. And the refinery maintenance schedule could be pretty heavy this year, because some refineries might start to make some tweaks ahead of the IMO 2020 rules that are due to come in at the beginning of 2020. However, once we get into Q4, we think that demand could strengthen again. In fact, according to the IEA, refinery throughput in the second half of this year is expected to be 2 million barrels a day higher than the first half. And so we do expect demand to be stronger once we get through refinery maintenance. And we expect that OPEC will ramp up production to meet this demand, which means more cargoes in Q4 and a better winter market than we saw last year. The one wildcard that could offset that positivity is Iran. Now, the US sanctions on Iran come into play in November of this year. And some countries are already starting to cut back on Iranian import volumes. And depending on how deep those cuts are, we could see Iranian exports come off quite significantly, which could offset some of the increase in production that's coming elsewhere in OPEC, like from Saudi Arabia. So that's definitely a development to keep an eye on. It could offset some of that positivity that I talked about previously. But as well, it could also drive some Iranian ships back into floating storage, which would help tighten the tonnage balance. So we do expect overall on a net basis that Q4 will be better, and that the winter market coming up will be better than the winter market we saw last year. Looking ahead a little bit to 2019, a lot of the fundamentals are still very positive. The forecast is for 1.5 million barrels a day of oil demand growth next year. We do expect quite a bit of non-OPEC supply growth, especially from the US. So we expect more US crude exports, more exports from Brazil as well, and parts of Russia and the former Soviet Union. Also, crude oil stockpiles are pretty low right now, so we could see a period of stock building next year, which would be good for tanker demand. And fleet growth, although it will probably be a bit higher next year because we don't expect to see the same amount of scrapping, it should still be relatively low at about 3 to 3.5%, which is below the long-term average fleet growth of around 5%. So we are quite positive for next year. And we also think that as we get deeper into 2019, the impact of IMO 2020 could be quite positive for the tanker market as well, because refineries will start to have to start increasing throughput in order to make enough low sulfur fuel to supply the bunker market from 2020. And that will create new demand, and it will create new trade routes and possibly some floating storage as well. So we think as we get particularly into the second half of 2019, that could be a really positive event for the tanker market. Just a couple of wildcards to look for next year that could offset some of that. We are keeping an eye on what's going on with the US and China in terms of trade tariffs and whether that will emerge into a wider trade war. And we're also starting to keep an eye now on some of the emerging market economies where we're seeing some weakness, some currency weakness, especially in Turkey, given the US has put steel tariffs and aluminium tariffs on Turkey. That's really had a big impact on the Turkish lira. And there are some worries that some of that contagion could spread into other emerging markets, which combined with the sort of trade wars and the tariffs could have a dampening effect on the global economy and oil demand next year. So it's not really something we're factoring into our base case yet, but it's certainly something to watch out for and something that could just take the edge off the global economy and oil demand as we go into 2019. But overall, we do see 2019 as a better year for the tanker market. So it's a recovery that we believe is starting now. We'll gather pace into 19, and especially during the second half of next year and into the early part of 2020, especially as I said before with the introduction of the new IMO 2020 rules and all the positive impacts that we think that will have on the tanker market as well. So that's our update on the conventional tanker market, and we'll speak to you again next month.